It is a rainy Thursday afternoon where I'm at over in Los Angeles, California. So hopefully you guys are getting some better weather than I am today. But nonetheless, it is good to be with you all. Thank you for joining. Hello, Robert. Hope all is well, sir. Um, so topic, today's topic, we're actually discussing tax planning. And the title of the conversation today is Three Ways a Tax Plan Can Actually Save You $20,000 this year. And I'm talking to my real estate investors specifically, but this is definitely transferable to anyone that is a business owner, anyone that has investments, and anyone that is considered to be a high income earner. But I certainly want to definitely shout out the real estate investors and highlight some specific areas that they should be considering and taking advantage of in order to achieve this savings on their taxes. So, for those that don't know, my name is Jamel Nelson, and if you are new to me, new to this format, um, I'm the owner, founder of Nelson and Associates, and we actually are a firm that specializes in accounting, tax, and advisory. So, a lot of what we do with our clients is in this realm of the topic that I'm going to be discussing today. And this is actually with regards to tax planning and being proactive with your outcome of your tax liability. And the reason we're having this conversation is because there's a problem. And the problem that I am continually encountering and facing with individuals that I interact with is the fact that they are either business owners or real estate investors, and they are not including tax planning in their program. They're not including tax planning as part of their tax plan or strategy for their business. And this is a big issue because they are, in effect, not aware of the potential savings that they could be experiencing, nor are they aware of how much money they are actually missing out on keeping in their pocket because they're not tax planning. And the reason this is because it's not necessarily their fault, but it is because they are either miseducated or they're not educated on really that this is a possibility or that this is an opportunity that they should be considering. And to get us started off with the conversation, I first want to address the issue of tax preparation versus tax planning. And when it comes to tax preparation, everyone needs a tax preparation to be performed for their individual or business activity. So that, without question, is a guaranteed situation that most people will experience or be faced with. However, the issue with the tax preparation is that it doesn't necessarily do a full out analysis or a deep dive into specific strategies and the potential strategy that should be considered given an individual's situation or a business's situation. Rather, what a tax preparation process does is it essentially just takes the information that occurred in the past, and we're reporting on that information to the best of our ability and to make sure that it's done correctly. And that's essentially all the tax prep process entails. And the issue with that is, again, because everyone has to have a tax preparation performed for their individual or business, they oftentimes are obviously just going through the process, in and out of the process every single year. And if you're not necessarily working with someone that specializes in the tax planning aspect of this process, then oftentimes those individuals are either not aware that they should be considering or that they can consider. So what they do is they just continue year in and year out with the tax preparation process. And the issue with that, again, is it's not proactive. The goal for a tax preparation is to obviously reduce, it's not necessarily to reduce the tax liability, but it's pretty much just making sure that you capture the information correctly and report it correctly. Now, on the alternative, a tax plan is a process in which you are more proactive, more so than you are with just tax preparation. This is a process in which you're actually analyzing the individual or the business activity and identifying projections of what will occur And based on those projections, you now are being proactive in that you are identifying specific strategies or things that the individual or business should be doing in order to reduce the taxes, so that by the time it's time for the tax preparation, all of those strategies have been implemented and will take effect in order to reduce the tax liability. So for those that are considered individuals that are business owners or real estate investors, they most certainly will benefit more greatly for a tax plan rather than someone that is just an individual that's considered to be a W-2 employee. Although they may not be a business owner or a real estate investor, they can still benefit from a tax plan, but their opportunities are limited and not as plentiful as they are for a business owner or a real estate investor. So if you're a real estate owner that actually has investment property and or owner of a business, you by far have way more opportunity to benefit from a tax plan than an individual. So I just wanted to be clear that individuals can benefit from a tax plan, but they may be limited with what they can do and the savings that they can achieve based on the way that the tax code is set up, unfortunately. So when it comes to a tax plan, one thing that I want to make a note on and make mention of is that a tax plan is a separate process, it's a separate service than a tax preparation. And it is truly indeed an investment. It's an investment because it is money that you actually have to pay for this additional service. But keep in mind, even though you're paying money for this service, I would like to encourage you to look at this as an investment, because this is an investment that is ultimately going to be a return on your investment, even though it may cost upfront capital to obviously engage to perform a tax plan. The end result is that it should not cost you more money than it will save you as a result of the tax plan. So I say ROI, return on investment, because it is an upfront cost, but the upfront cost should greatly outweigh the benefits of what you will be receiving in terms of money you keep back in your pocket from the tax savings that will be identified and achieved as a result of the tax plan. So with that in mind, what I wanted to do is do a quick demo on pretty much what a scenario looks like for a individual that is to be considered a business owner or a real estate investor. I want to do a demo on what that scenario looks like if they did not do a tax plan versus if they did do a tax plan. And then once I complete this demo, I'm actually going to provide a couple strategies that I think are worth considering and that you should be obviously paying attention to, specifically as a real estate investor. So with that, let me actually get my screen shared. And what we're looking at right here is the scenario of an individual that does not do a tax plan. And then we're looking at another scenario in which an individual does do a tax plan. And my caveat with this is that this is obviously for illustration purposes. This may not necessarily be your specific case or your specific situation, but this is a good example that I want to lead with, just to definitely identify the process of what the tax plan input and output can look like if you were to consider performing one yourself. So when it comes to the scenario one is a typical individual that does not do a tax plan. They maybe have a job, they maybe have investments, they may have businesses. And what happens for this individual is at the end of the year, once the year is complete and they go into the new year and it's time to file the tax return from the previous year, what that process looks like for that individual is essentially compiling all of the 1099 forms, compiling the W-2 forms, gathering all the information on the business activity, and providing those forms and documents to the tax professional to prepare the tax return. And what happens is once all of the information is input into the tax forms, there's either going to be an outcome of money owed or a refund coming back. And in this example that I have here for scenario one, if the outcome is that the individual owes money, it looks as if this individual owes $30,000 in taxes. And this is purely just a function of taking the information from the W-2, from the 1099, from all the sources of tax records to identify what this individual is on the hook for. So at this particular point, this is pretty much just a matter of making sure you gather all your documents and input the information correctly without any error. And based on that information we now identified that this taxpayer owes $30,000. Now, in addition to this $30,000, this individual also is on the hook for the tax preparation fees that they're going to pay this tax professional to prepare their tax return. And that's an additional $1,500. So all in all, for the year, this individual is on the hook for $31,500. And this is the individual that did not do a tax plan. They essentially just went through the course of the year, gathered all of their information at the end of the year, and handed it over to their tax professional to proceed with filing the tax returns rather. So that individual is now on the hook for $31,500. Let's take a look at scenario number 2. Scenario number 2 is an illustration of the same individual that actually identified a need to actually hire a tax professional to assist with some tax planning. And this is because they've either gotten fed up with the fact that they owed taxes in the past and they do not want to pay a cent more or a dollar more in taxes if they don't have to. And in order to do that, they've identified that, hey, I can't necessarily just go through the year and cross my fingers and hope that I don't owe anything. I actually need to be more proactive. I need to take a more proactive approach, proactive stand in being intentional about really impacting the outcome of my taxes. And because that individual came to that realization, what they typically are going to do now is seek out someone that's considered a tax professional that specializes in tax planning. And they've identified this individual that specializes in tax planning to actually assist them and guide them with strategies and specific ways in which they should and could reduce their taxes. So in this scenario too, this individual obviously identified the need to enlist some assistance to guide this person in this pursuit to save taxes. And at the beginning of the relationship, when they identified the need to hire this tax planner, what they identified is that if they didn't do anything different than they did in the previous years, if they kept doing everything the same, they would owe the same $1,500 in the following year. However, because they obviously projected that this would be the case in the scenario, what the tax plan allowed this individual to do is they were now in a position where they identified their scenario. They identified that they were a business owner. They identified that they were a real estate investor. They identified that they had specific activities going on within their individual as well as business. And because of all of those situations being discovered and discussed, we now can go back and research the IRC code, which is the tax code, and be able to present opportunities in which this taxpayer can actually take advantage of tax savings. And in doing so, it's a process of really identifying strategies that this person is available to take advantage of. And because of these specific strategies, we are actually going to be more intentional with identifying them and ensuring that they are acted upon so that we can now reduce the taxes from being $30,000 to now a lower amount. So in the situation in which this individual did pursue a tax plan, they were able to identify strategies that they didn't necessarily implement. Maybe they were aware of them without the tax plan, but now that they are aware of what the strategies are and now that they are going to implement them, we were able to obviously identify savings of $25,000. So this individual is now able to keep $25,000 in their pocket instead of forking it over to the tax authorities. However, what they do now have to do is also pay for a tax planning fee, which in this illustration is $3,500. And in addition to the tax planning fee, they're also going to pay for the tax preparation fee. So in total, this individual is out of pocket $10,000 as compared to the $31,500 if they did not do a tax plan. So as I mentioned earlier, a tax plan is an investment. However, I look at it as a return on investment because a tax plan should not cost more than it saves you. And the beauty of this scenario is that this is the tax plan for this year. If this individual situation is going to be consistent the next year and the next year and the next year after that, chances are they don't necessarily need to pay for a tax plan the following years. They could pretty much use the same plan year after year and not have to pay this $3,500 the next year after that and still save the same amount that they are reflected here as compared to what they would have paid if they did not have a tax plan. So that is the beauty of a tax plan. The tax plan is really working with an individual that is obviously experienced and familiar with your situation so that they can advise you on specific strategies and things that you should be thinking about, things that you should be doing in order to change the outcome of what your tax liability would be if you did not pursue a tax plan. So this is the demo that I wanted to share with you all in terms of what it looks like if you don't have a tax plan versus if you do have a tax plan. And what I want to do with this is ask a question. And the question is, what would you do with an extra 20K or more in savings if you had that? And it is very realistic and very possible for you to actually have 20K or more in savings if you're a business owner, you are a real estate investor. And you're able to do this because you're going to utilize a tax plan to identify strategy that can actually help your cause so that you can not necessarily have to pay the full amount in tax liability that you would if you did not use these plans. And I know for myself, if I was able to have 20K plus in savings, that would potentially give me an opportunity to go out and invest in more real estate property, have more cash flowing assets that I can now put into my portfolio. So ultimately, at the end of the day, the tax plan is going to be in a position where it's putting you in the driver's seat, where you're proactively in control of what the outcome will be for your tax liability for that given year. Now, I mentioned that there were a couple of things that I wanted to share for my real estate investors in terms of strategies and things that they should be considering in order to really achieve this 20K plus in savings. So as I mentioned before, if you're a business owner or real estate investor, there are plenty of opportunities for you to take advantage of with regards to your tax savings. And there's three that I really want to highlight and share with you all. And the first is going to be a cost segregation study analysis. So this is probably the biggest and the most impactful strategy that I use for my clients in terms of saving them tens of thousands, if not hundreds of thousands in tax savings. And a cost segregation study, pretty much what it does is it allows the property owner to actually maximize their depreciation expense so that they can actually take depreciation expense and front load it in the earlier years of their asset's life versus take little by little depreciation over a course of a 27 plus year period. So what we do is we actually work with the individual, identify what their assets are, identify, do an analysis on their portfolio, and we pretty much work with a team of individuals that are considered professional service firms that specialize in the cost segregation study. And with that partnership, we're able to obviously identify and document the support to allow us to be in a position to front load this depreciation. And this is the strategy that, again, is the most impactful for my clients. In addition to a cost segregation study, you also have what we call the real estate professional status. And when it comes to the IRS, they identify investors in three categories. The investor is either going to be a passive investor, an active investor, or a real estate professional. And if you are an investor that's considered a real estate professional, you are now in the driver's seat because you can take the most advantage of the tax code in identifying depreciation against your taxable income. You can do that more so than you can with the other categories. So if you're not aware of what a professional status is, I would definitely incline you to actually do your research and make sure you understand what that is so that you can make the most of your tax deductions if you are a real estate investor or professional. And then the third one is going to be short-term rentals. So short-term rentals, this is kind of connected to the previous professional real estate status that I mentioned earlier. But ultimately what this does is it provides a loophole to the real estate professional classification, because in order to meet the real estate professional status, there's specific criteria that you have to maintain. And unfortunately, not all individuals can qualify for the real estate professional status. However, you can actually qualify for a short-term rental and not be a real estate professional status and take advantage of the same benefits. So these are the three areas in which you could for sure be in a position where you could be saving that 20K plus on your tax bill every single year. Now, with this information, obviously, it's not necessarily about how much you make, but it's all about how much you're keeping in your pocket. And in order to really influence how much you're going to keep in your pocket, you're not going to be able to keep as much in your pocket if you're just haphazardly just going through the year and filing your tax return. You actually have to be proactive, and you have to take an active stand in identifying the need that, hey, if I am not aware of how to do these strategies or even aware of these strategies, I need to now identify a professional and identify a tax plan as part of my business plan so that I can obviously keep more money in my pocket. So that's the first thing that I wanted to really highlight and communicate to you all, because as I mentioned earlier, the biggest problem that I'm seeing is that the individual business owner or investor, they obviously have the assets, they have the successful business, but they're not keeping all of the money that they should be keeping because they're not proactively tax planning. What they're doing is they're just filing their tax return. So that's the first takeaway. And then secondly, I want you to not necessarily just think about tax preparation. Think about tax planning. Tax planning is your best friend. You need tax preparation, yes. But if you're not doing a tax plan with your tax preparation, you're creating a disservice for yourself. So with that, I hope this was helpful for you all. I hope this is something that is not the first time you're hearing, but hopefully this could be a good reminder, considering that we're now at the tax filing season, which is ultimately top of the mind for most folks. So if you're not in a situation where you're working with a professional that can provide a tax plan for you, certainly look to us if you're looking for some individuals to maybe consider. We actually specialize in tax planning for our clients, and specifically for our real estate investor clients. So if you have any questions, you can feel free to leave a comment, respond to us, contact us by way of our email, Facebook, Instagram, wherever outlet or sources you find us, you can reach out to us, and I'll do my best to get back to you as soon as I can. And with that, I hope you guys have a great one. Appreciate you for taking some time to listen in, and we'll see you on the next one. Hope all is well with you, and take